Hey guys, Happy New Year and thanks for watching the Graham Strategy channel, where I follow a portfolio of stocks chosen based on the Graham 7 criteria for the defensive stock investor. As always, I remind you that I am not a financial advisor and I do not make any recommendations on what you should or should not buy or sell. A turbulent stock market year has come to an end and we will sum up what has happened and see how the Graham portfolio has performed. The Swedish OMX30 index has dropped 15.5% the past year, and the key drivers behind this decline are the Russian invasion of the Ukraine, which has increased the uncertainties in the world. It has affected the supply of many resources and is one of the main factors behind the high energy prices, in particular cost of electricity in Europe. The consequence of the high energy prices and the relentless money printing of the world governments have led to high inflation. This is a major change as we haven't seen such high inflation in over 25 years, and many investors are not familiar with this environment and do not know how to invest during these circumstances. This has in turn forced the central banks to increase the interest rates. We now see the ECB deposit rate at 2%, the Swedish reference rate at 2.75%, and the Fed's funds rate between 4.25 and 4.5%. However, it seems like the bear market bottomed out in October and the index has started climbing again. The earnings in Q3 were actually quite good for many companies, which can explain why the market has recovered, but the coming 2 quarters may not be as successful, as the purchasing power of many people has declined, as prices have increased significantly and the cost of interest payments on mortgages has doubled or tripled in combination with very high energy prices. Thus, the earnings of companies that rely on consumer spending will likely go down, and layoffs will be announced when companies try to reduce the company costs. All these things combined should put downward pressure on the stock market, but as always, it's impossible to predict how the stock market will develop in the short term. In the long term, however, the best prediction is a continuous increase in the stock market. The famous investor Peter Lynch said in his famous speech from 1994 that the Dow Jones doubles every 8 to 9 years, and I put a link in the description to his talk. That was 28 years ago, and it was based on historical data back then. How has it held up since then? Well, when he gave his speech, the Dow Jones was roughly 3,600, and it peaked in December 2021 at about 36,000. That is a 10 times increase, but let's do the math with the current figure of around 33,100. That is more than a 9-fold increase, which implies an average return of 8.24% per year since 1994, or a doubling every 8.75 years. So a pretty good prediction, I'd say. So a doubling every 8 to 9 years is what one can expect from a typical value stock investment. What could you do if you want even higher returns? Well, the index is the return without dividends, including also an average dividend yield of 4%. Your investment could double every 6 years. And for even better returns, a smart investment strategy could be employed. The Graham strategy is one such strategy that is followed by this channel. It has potential annual return around 21%, which means it doubles every 4 years or 7-fold every 10 years. You can learn more about this in my first video, which is linked in the description below. With this in mind, let's see how the Graham portfolio has performed so far since the start in March 2021, that is 22 months ago. The portfolio has gained 38.4%, which corresponds to an annual increase of 19.4%. Which is very good if you compare this with the OMX30 index, which has had an annual return of only 0.7% during the same time. One thing that I've noticed is that the Graham strategy seems to perform about as good as the index, including dividends, during turbulent times, when most retail investors are sitting on the sidelines and professional investors dominate the market. But as soon as things calm down and the retail investors come back, the Graham strategy performs much better than the index. And finally, let's have a look at what stocks are at the top from a Graham rating point of view. The top 5 stocks, all fulfilling the 7 Graham criteria. See here. They are the same as the ones that are already in my Graham portfolio. They should thus be well positioned to withstand a continued recession, as well as perform well if the economical situation changes and the outlook becomes more positive. So, that was all for today. Stay tuned for updates on the portfolio, subscribe and hit the notification bell to receive updates when I release a new video. So until next time, as always, stay sharp and follow your passion.